This is a download from BFM 89.9, the business station.
Good morning, Dodge. China's rate cut came just 4 days after they announced their third quarter growth fell below the targeted 7%. What does this tell you about the government's concern over the pace of the slowdown there?
Good morning, Melissa. Well, it says that it implies that they're much more concerned than what is being said. The fact it was 6.9% versus a year earlier, that is a small gain since 2009, and it's below the target. That's the absolute. But let's take a look. They have the sixth rate cut since last November. Mm-hmm. They also relaxed the bank reserve requirements, meaning both of these are fairly significant. And Friday's move was largely unexpected because of Beijing's lack of transparency. So the fact that it was unexpected does say that we're looking for more concern as we go forward. Also, over the past few months, the Chinese government has been willing to cede some of its control over desperately trying to control everything, and they're trying to focus on growing the economy. Also, Melissa, what we see now is a greater divergence between the government data from economic reality. We think that the actual growth rate may be as much as 1.5% below the official numbers. So I think there is a great deal of concern about the future growth.
Well, you mentioned you're right. Beijing has made this move several times in the past year, but to little effect. So what makes the government there think that this time it might work to spur economic growth?
Well, I'm not sure. I don't really have an answer because monetary policy is really not the solution to China's slowing growth. In fact, it may be that they may be at that point where it's actually reached the point of pushing on a string. Monetary stimulus can't manufacture demand. And if you take a look at the fact interest rates have fallen considerably at banks and shadow financial institutions since the fourth quarter, but the share of the firms borrowing or seeking to borrow has fell in the second quarter to tie the lowest levels in the survey's history that we're relying on. And so I don't think there is a compelling reason to really think that monetary stimulus is going to be the answer, but it is the one thing that the government can do right now, and there is a hope that it will continue to support growth.
Dodge, central banks are now back in the spotlight. The U.S. Federal Reserve will be meeting this week. Do you think that how do you think the Fed will react to the easy money moves by China and also by the ECB that just signaled it might consider more QE?
Oh, yes. It's across the board. It's clear that the central bank tide has turned decisively towards more easing, and that will affect the Fed. In fact, if you look at the markets and the Fed rate and the implication right now, the first Fed boost is now being pushed further into the future. Other central banks are dealing with weakening growth. The odds are 2-1 against a liftoff in rates here in December, and it's less than 10% for this month. So what we're really looking at is there's a 60% probability that's being funded built into the Fed funds rate that the increase will come in March. So we suspect that although they're not supposed to be guided by what's happening abroad, their perception of what's happening with easy money rates across the board has a negative implication to us, and therefore we will have a delay.
So what will this delay mean, Dodge? I mean, in removing that easy money prop to world markets? Well,
eventually we will have to transition from markets that are being valued based on easy money to fundamental strength. It's being delayed. What we're seeing now, Melissa, is the markets are beginning to narrow in the number of stocks that are participating to the upside. Basically, it's the large caps over here. But there are more and more stocks that are finding weakness because they're not being supported by fundamental strength or the perception of fundamental strengths going forward. So it's good. You have to participate in the market on the upside because right now there is a tremendous support from a money point of view. But at some point, unless the transition starts to occur sooner rather than later, you're going to see a lack of confidence in the fundamental strength of the markets, and that will be affected that will be built into the market reaction.
Well, just going back to the slowdown in China, Dodge, I mean, several companies that have a strong focus in China, like Apple and Alibaba, they're set to announce earnings this week. Are you watching very closely the impact of the slowdown to companies like these?
Oh, yes, Melissa, very, very important. I mean, Apple is reporting Tuesday after our close. They're expecting $1.88 and in EPS and $51 billion revenue. We'll be watching that. But the potential competitive pressure is ramping up, particularly in China, where the local OEMs are increasingly bridging their gap with the iPhone. And we're going to be watching that to see if that creates a downside or some real pressure on the future of Apple in China. And Apple remains a one-product company that centers around the iPhone. So this is very important. Now, Alibaba has, they were really affected by the reduction in interest rates, that 25% decrease, that 25 basis point decrease that you mentioned. The fact they also have a Singles Day coming up next month. So there's some real benchmarks we're going to be watching. We're going to see if the expectations for their holiday created by Baba back in 2009, which is really cool, the busiest shopping day in the Chinese calendar, will reach the expectations. But there are several concerns. We have lower cash flow growth rate, relatively high debt-to-equity ratio versus the industry, and the market expectations for an improved product delivery and also an improved EPS is going to be very high challenge for Baba to meet. So we're expecting Baba to have, and if you take a look at their activity, they've broken through some short-term support. So if they can get into the $78 to $80 range, there may be further move to the upside.
Thanks for speaking with us today, Dodge. That was Dodge Dorland, Chief Investment Officer of Landor and Fuest Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.
This year, I will chew 117 number 2 pencils.
I will doodle 9 Staples notebooks to death.
When it comes to school supplies, it's guaranteed your kids will go through a lot.
I'll make a whole lot of paper airplanes.
I will lose my backpack.
That's why you get guaranteed savings for back to school at Staples.
I'll give away my last pen to Nathan in math class.
Get guaranteed savings at Staples, and right now, one subject notebooks for just a penny with a $5 purchase. Staples, that was easy. Valid on select SKUs while supplies last. Limit 6, ends 8/25/12.